I hate to say it, but it looks like the housing market may have just cracked. We're going to be going over what that looks like in this video with a lot of data that we have compiled and asking the question, well, should we be worried? We're going to start off by looking at how the market has been performing and then go on to analyze this data a bit further. Again, we have compiled a lot of info in this video, so if you enjoy this sort of stuff, do subscribe. We're going to start off quickly though by looking at a few factors which we have seen in recent months. So the housing market has been rallying heavily for several months. In the last video we touched upon how July marked the 125th consecutive month of growth in this sector. Growth has been particularly rapid throughout 2022, with prices seeking continuous increases in growth throughout the whole year. This is shown very clearly on this chart. So what we have here is a chart which shows home prices did rise by 10.8% in July, marking the 125th consecutive month of year-over-year increase. Now, whilst we're seeing growth continue into July, the rate of growth slowed down for the first time all year. Could this be the start of a decline? Well, it looks like it could be. Let me explain. So coming into 2022, we saw slow but steady increases, which really started to explode coming into February. Then we saw rapid growth all the way up until June. Now, of course, in July, yes, we were up quite significantly. However, the increase that we are seeing compared to previous months and the rate that we are seeing and the trend that we are seeing, well, it's not following that level, is it? Because we are starting to see, again, a decline in the rate of growth rather than more rapid growth. And this makes sense because at some point this is going to have to end. The bull market can't stay forever, especially when it is rising at this rate. We're seeing house prices really start to rocket. And again, that's going to have impacts on people. So here are a few of the factors that we are seeing both in this market but also in the wider economy. So home prices are at all-time high levels. The economy isn't looking too good. The stock market is down and we're looking like we could be entering a recession. Alongside this, we have rapid inflation and low interest rates, meaning that people have less real terms pay, putting pressure on people's finances. And of course, with the markets being in a decline, potential recession coming, companies are going to want to maximize profits and have less money to waste. And how that's going to happen is job cuts and mass layoffs. We're already seeing in early 2022 a lot of major companies letting employees go, and a significant proportion of employees. And what's going to happen then is people won't be getting paid. They are going to have difficulty paying their mortgages, which is probably going to lead to increased defaults. Now, average rates of 30-year fixed mortgages are at the highest level since 2008, putting additional pressure on people's finances and again potentially leading to more defaults as people just struggle to pay these high prices. So the rate of household debt is also a key factor. We're seeing this rise significantly, and whilst debt can be a good thing, when it spirals rapidly like what we're seeing right now, it can lead to difficulty, both paying it back but also economic difficulty on a wider level. And the bottom line of this is, fundamentally, looking at these conditions, the market is weak. There's no true reason to see more rapid bullish growth, because we're not really seeing a strong economy. We're not really seeing a point where people are getting paid very well. We're not seeing a point where people have an excess of money at the moment, as we obviously all feel right now. So yeah, that is going to be difficult. In real terms, what we're seeing is house prices are not rising at the same level as people's earnings. This chart shows the increase in house prices versus people's earnings. Last time we saw a spike this high was around 07-08. And what this simply means is the price of property is very, very steep, but people's pay is not matching that. What's going to happen then is it's going to be harder for people to afford properties, and there's going to be a few repercussions of that. So there are many ways to look at this. So when house prices don't rise with earnings, we can expect to see two things probably happen. The first one is going to be less demand, because if a house is 50% higher, for example, than what it was last year, people just can't afford to pay that. People can't afford to keep up with the mortgage rates, people can't afford to keep up with the monthly payments and all of that sort of thing. So there's going to be less demand to buy expensive properties at these prices when they are fundamentally overvalued. And the second thing that we're likely to see is people who already own homes looking to release some money from that property because they have seen the value of their property rise rapidly, and they're going to think, hang on a minute, well, this property is now worth 2, 3, 4, 500 grand. Let's try get some money out of it. Now, there's two ways, of course, that we can do this. There's probably more, but here are the two main ones. The obvious one, to sell the property, and the other one is, of course, to get a home equity loan. So let's have a look at what we are seeing in this market right now. When it comes to demand, what we're seeing for home equity loans is the search term. This is Google Trends. The search term for home equity loans, it is up. Last time we saw it this high was around 04. So again, where we saw property prices quite high before the 07-08 crash. And again, coming into where we are right now, coming into 2021-22, we're seeing a rapid increase in searches for this term, meaning more people are probably thinking about it, i.e. more people want to do this as they want to free up some money from their property. And again, on top of this, if people are selling houses in mass, it means that the market's going to get a bit more diluted, again leading to the simple economics of supply and demand, meaning that each house is going to be worth a little bit less as there are more options to choose from. So that's one term that I'm looking at. And the data does also show that at these high prices, people just are not buying properties at the same rate. So this is the data from July. It's from the National Association of Realtors. And it shows home sales are down by 5.9% in July compared to June. The 6th month in a row that sales have declined. They're down 20.2% from a year earlier. The same report found that median sales prices are 403,000 compared, or rather down 10,000 from June. So again, what we're seeing right now is less demand to buy houses at these higher prices, but also again the value of these properties falling a bit. Again, is that because people are selling at these higher prices? Who knows? Again, all we can do is speculate, but I think it does all tie in. Again, people are going to be more reluctant to buy at this point, simply because one, they don't want to, and two, they just couldn't afford it even if they did. So again, that's one thing which could affect us. Now, in summary, looking at all of this data, let's have a look at all of the things that we have compiled. Well, we can tell a few things from this. Again, the demand for this, whilst demand for homes is high, at this price, it's going to be hard for a lot of people to afford, simply put. Again, at this point, people cannot afford it. The increase in searches for home equity loans implies that people are looking to possibly increase household debt further, putting pressure on finances, as we have seen, and the effect that can have is something that we all felt in 07 and 08. Again, coming back a bit further to reflect on what we have seen, house prices are not rising with earnings, meaning people are going to have more difficulty paying for properties, i.e. leading them to not want to purchase at these prices. We're seeing this rise continue when it comes to property prices, but it is starting to slow down ever so slightly, and that is what leads me to believe this could be the start of the end of this bubble. Now, again, it's very, very early to say that this is over, and we will have to wait until the July to into August data comes out. But I think this trend is probably going to continue, because at this rate, property prices have increased significantly. People want to sell. People want to get equity out of their property, and again, people looking to enter the market just do not want to pay these high prices. So yes, I do think this month of July is quite significant, even if it does seem somewhat of a small decrease. If we are looking at these early stages at predicting a market decline, it is all about analysing the very narrow, the very niche data, the early signs, and again, this is nothing more than an early sign. So do not take it too seriously, this is just my opinion, but I do think this could be a sign that we are starting to see the decline of this bubble. So I want to hear what you have to say on this down below. Do you think this bubble is going to end, or do you think we have more room to run in future months? I do want to hear all of your opinions. And this is only my personal view, but in my view, what we're seeing with the house price increases, with the pressure on people's personal finances at the moment with inflation and economic downturns and mass layoffs, it's no surprise that we are seeing the demand for homes and sales in homes decline by quite a steep number at 6%. So if you guys have a different opinion, I'd love to hear it down below. But for this one, guys, it is a goodbye. Thank you so much for joining me all the way till the end. Goodbye.